Good weekend. Ira Epstein with your financial market wrap-up, and this wrap-up is for Friday, the 12th of July, 2024. And what a week. You know, we didn't quite get the trifecta. We were hoping to see, and we did get for the month of June, that is, a weak labor report. Not weak in the sense that falling apart, just weakening. We saw a CPI that certainly showed inflation is now from that sticky point resuming back down. But today we had a negative to the deal, and that's that the PPI came up. Now, the PPI is used figuring out a lot of the PCE numbers as well, so we'll see how those come out a little later. But this was not the trifecta that the market was hoping for, and you did see that the bonds and notes, when they got that, they held on to gains, but they didn't really drop in yield whatsoever, pretty much unchanged on the day. Stock indices all came alive. So what we saw off the CPI was so interesting. The market saw a plunge, and that I think is the right word, in the Dow and the S&P on Thursday. Today, those two markets came roaring back at you in the marketplace. They got up at one point. You're looking at this at 57.08. Yes, it closed 56.64. So it gave up 44 points of that. It was up 69 points. In the Dow, you had gotten up to 40,572. You gave up 200. So you came all the way up, settled back on it. But here's how I approach it. We had a broadening out is what looks like it took place, because the gains went into the NASDAQ and the gains went into the Russell. Yes, they gave back a little bit from their highs today. Okay. Do I think the market's going to run and chase these markets right here just because we might get in September a rate cut? I'm not convinced that that is the case. I think the market has to look at things, and somewhere along the line, this market's got to make up, is bad news good news or is bad news bad news? Somewhere along the line, they're going to figure that out. You saw a bit lower in all the energy products today. The grain market, this is the growing season. We have the supply-demand report today. I was looking at this market, and we're looking at price counts. And if you get our free offerings of price counts, which I think are phenomenal, you look in the 390, 395 area. You're in an area, as Gordy Linn calls it, a circle area. We're pressing this market under $4. Doesn't mean you can't go lower, but you're into a high risk area there of trying to press it. So getting a little bounce off those lows. And the bean market sort of just stalled out in things. The dollar down again, and we saw pretty good gains still coming into the Japanese yen. This market is now really ratcheted up, got up as high as 64.17. The word was there might have been a bit more today in the way of some intervention. Now, let's go to the weekly charts and take a look. And I always start off on this program with you on the monthly S&P. And I should mention at this time, I am going to take off for vacation for a little bit right now. So I'll be around, but I'm not going to be doing my updates this coming week other than sporadically. So if you're looking for the morning update or the evening ones, they might be there, they might not. I will be back on a week from this coming week. So just a short period of time to clean out the brain. You know how that is, but I don't take that many vacations to begin with. So coming into the market at mid-month, all-time highs, not bad. You're up 2.59% at mid-month here. When we look at the S&P, you finished off another week at a record high close. Not bad. I mean, that's how the weekly chart looks. When you come over and you see how it's gone up, still moving to the upside. Now, there's a common theme here. Many of these slow stochastic studies are embedded, and they've been kicking these markets up. They've gone to the upper Bollinger Bands, which you'll see in a minute, and that's been something of a resistance zone. But you have a pattern, and see these lines that I draw? Those lines are called a swing line, and they attach each bar. Each bar is a weekly bar. And I have 5 sets of rules in my charting course for how the lines are drawn. And very simply, what you're looking for are patterns that say, are you trending or not? I think if you go to any basic book on charting, you will see that an uptrend in large part can be defined as a market that's making higher highs and higher lows, or lower highs and lower lows. There's more to it than that, but that's a good part of the basics. By measuring that, what I can tell you is what you don't want to see is the market get back under 55.0275. It would break the pattern of higher lows, higher highs. So uptrend still in place. You also have a bullish trend that's been in place for a long time where the shortest term average, the 18-week, is over the 100 and the 100 is over the 200. So where's the resistance? Typically the Bollinger Band. And the market got up to this about 3-4 weeks ago, came back and has fought its way all the way higher. It's called the Gorilla Glue trade. And what happens when that occurs is the market will force the momentum index, the slow stochastic, off into embed. Embed means the two numbers that make up the index, the red called the K line, the D line, both get over 80 and stay over there for a minimum of several periods or more, a period being a weekly bar. As the market does that, it's saying on pullbacks, buy the market until the red line closes under 79 when momentum is broken. I'm giving you the simplistic part of that, but that's what it is. So, in summation, you have a market that has got bullish momentum locked in until the red line closes under 79. It's a weekly chart. You have a pattern that's bullish in higher lows, higher highs. If you look at the momentum line that defines bias, it's up because you're over the 18-week average. Under it would be bearish, over it. So the swing line is up, the bias is up, and momentum's locked in. You're still very much in a bull trend. In the Dow, the pattern's a bit different. Number one, you've been trading between the Bollinger Bands for a long period of time. That's a good thing, not a bad thing. So what the market is doing is in this sideways action, just think of it as a pipe. And in the pipe, the spring is price. And you're winding and winding and winding, and it's going to break out either to the upside or the downside. For the week, the market finished off strong. You finished off at the 40,301. And that puts you up against the upper Bollinger Band, as you can see right there. And you're overbought. So you need to get over these bands and stay over them to say you're breaking out to the upside. This is where I think the pros took some money off the table this week at that level. When we take a look at the NASDAQ, again, the Gorilla Glue trade. You locked in, moved on it all the way, and until the red line's under 79, you're there. And in the Russell, it's like the Dow. But the difference between the Russell and the Dow is the market closed over the upper band in the very top part of the week. If we get another week where we make a higher high, close higher than this week, and in the very top part of the range, let's say the top 20% or so, then I'd call that an upside breakout. I can take the width of this band, flip it over, and it gives me an objective where the market might be headed. In addition, until this low is taken out way back down here, I view the market as having converted itself and being bullish, period. When I look at the 5-year notes, it's more reminding of the Dow and the Russell. It's got sideways action in the Bollinger Bands coming up to resistance of the 100-day average in the green bar. And in the black, that's the upper band. Overbought. This is where I think against this number, the pros are taking some money off the table. And I see the same thing occurring in the 10-year note. In the dollar index, we've broken down into a downtrend. You have lower highs, lower lows. I would expect the pros to be selling in this range right here between the 100 and the 18-day averages, with stops back over the 105.71.5 zone, looking for the market to still get down possibly to 103.36. In the eurocurrency, we have higher lows, higher highs, which means this market might easily kick itself up to even higher levels in here, which could carry it. I'm looking to see if I've got my phone. I don't, unfortunately. It could be going up to the 109.40 area, so I'm still looking for higher prices there. In the Canadian dollar, I'm sorry, I'm going to continue it. That'll stop in its due time. We are looking at a market at the 100-day average, the upper Bollinger Band, up and away. That's my wife. She went to the Chicago concert tonight, so we know the manager of that, and I know that she's with him and probably meeting all kinds of people again. They're good friends. Lower highs, lower lows, getting a bounce out of this. We'll see if the market can get up to the 64.77 area. In Bitcoin, still bearish. Could the market be going further down? It could. You'd have to take out last week's high. Remember, we had an outside week down, which is a continuation pattern. You're under the Bollinger Band. You bounced back into it this week, but you're still very much in a down pattern. You are oversold. I think the smart money took some shorts in, maybe all of them, and they're waiting for proof the market can work its way lower. The market got disappointed because, as I see it, the SEC didn't approve the Ether thing. I haven't seen anything on it, but it was expected. They probably have to go back and file out more papers. Mr. Gensler is not a fan of these crypto products. In the differential between WTI and crude, well, as you can see, you're getting down to level numbers you haven't been at in a long time. We stayed and fought at this number from the beginning of the year, the 18-week average. Now we're breaking down. Could they be going to parity? It's a possibility. You see how the markets are just leaning in here with a pattern of a lower low, higher high. Once you challenge the first run at the 200-week average in the Bollinger Band, all you did is come up to the 100-day average and the 18-week average, not doing very much there. In WTI, lower low, higher high. You can see where the market's at right through there. Gasoline. This whole rally has just carried you back to the 18-week average. For me to get friendly the market, you have to close over 262.17. If the market can do that, that would then have higher lows, higher highs over the 18-week average, and you'd probably have momentum up. Barring that, you're in no man's land in this market. So you put it together, you try to come up with game plans, and that's basically what trading is always about. And we have a lot for you to choose from. If you look behind, that is the web page on our site for the free offers. And you just click one of these blue areas like you see there, it goes into a cart. And from that cart at the very bottom, you'll put in your name, your email. If you have a message for us, whatever it is, we'll get everything out to you. There's a lot to choose from. Access to my updates, access to one of the products I just talked about, which happens to be the price counts. You want to look at those. Free Quartz series, the Pivot Point, the Arun indicator are both there for you with it. The charting software you see me using here, you can get a trial to that. You can get a trial to the Linn research in addition to my written updates. More research. It's one of the areas that I work with. And what they do is they'll give you a free trial to their seasonality studies. And I've been using them, I want to say 30 years, maybe longer than that. So that's what the page looks like. Just go to iraepstein.com, free offers, or move your cursor to the top here and it'll take you there. Again, don't count on me on a regular basis this coming week. And after that, my vacation will be over. You have a great one, and I will talk to you all for sure in at least another week, but possibly a bit sooner at the end of the day. If I get time on vacation, I'll knock off a few videos. You take care.